Aditya Rathod, and welcome to today's presentation where we will be discussing about the beauties of tax planning, the dangers of tax evasion, and find out why GAAR is known as General Anti-Avoidance Rules and not General Anti-Evasion Rules or General Anti-Planning Rules, right? This is going to be an exciting explorations because we are going to go far beyond in time, about 20 years before. Okay, तो कहानी सुनोगे? कहानी सुनोगे? कहानी सुनोगे? Did they have a lunch break? So कहानी शुरू होती है कुछ 20 साल पहले. A UK-based company named Vodafone was looking to expand its business into India. They were looking for a company which has telecommunication networks and licenses. They found a company, Hudson SR Limited, there in the right corner, HEL. The problem with that company was, if Vodafone acquired that company, HEL, then HEL would have to pay capital gain on transfer of shares. Yes or no? So, here comes the twist. HEL was held by another company named CGP Investments. 67% of HEL was held by CGP Investment, and CGP Investments was a foreign company. If Vodafone acquired CGP Investments, it will look like one foreign company, CGP Investments, sold its shares to Vodafone Limited. It is an income outside India, so not taxable in India, and 67% of HL will be with Vodafone. बस और क्या, वोडाफोन ने 55,000 करोड़ का चेक फाड़ दिया और सीजीपी इन्वेस्टमेंट्स को खरीद लिया. टैक्स डिपार्टमेंट वेंट टू हाई कोर्ट, सुप्रीम कोर्ट. My lord, they have effectively transferred an Indian asset without paying capital gains. We are losing 12,000 crores of revenue from this. Supreme Court said, no. Section 9 says clearly कि income from sale of capital asset situated in India is taxable in India. Shares of CGP investments are not situated in India. Therefore, the entire transaction was non-taxable. Further, there were developments like retrospective amendments also, you can find out about that later. But from this transaction, government learned a very important lesson. That is, there are some transactions which are in the nature of tax planning, but which have objective of tax evasion. To understand that further, let us first understand what is tax planning. Tax planning is basically arranging your affairs or planning your affairs in a manner that law intended. कैसे? जैसे you are using ATC deductions, you are using ATD deductions. Suppose there is an SEZ, Special Economic Zone, where you get tax holiday. So you establish your manufacturing unit there so as to get tax reductions. That is tax planning. You can do that. Even the law itself is telling you can do that. Planning your sale after 24 months or 36 months so that you can attract lesser tax rate of long-term capital gains. And all of these decisions are pertaining to tax planning. Basically, law itself is telling you can take these decisions. And to go ahead, tax evasion. Tax evasion is something that is completely illegal. That is completely a violation, a concealment, where there are prosecutions. Basically, you are earning 1 crore of income, you are just saying, no, I earn only 24 lakhs of income because that is within the taxable limits, and you hide your 76 lakhs of income. There are bogus claims or expenses. There are expenses worth like 75 lakhs. I made expense of 75 lakhs which never took place. False deductions like ATG donations, we must have come across those donations if you working start audit, that some transactions are planned through trusts, through ATG donations. So all these kinds of devices or arrangements are tax evasions which are completely illegal in nature. But the grey area in between, which the government realized, it is in between, tax avoidance. Such transactions which are in the nature of tax planning, all the approvals are there, all certificates are there. If you look at the arrangement, agreement, contract, every step of that contract follows what the law intended. But the ultimate objective of that contract is to obtain a tax benefit. We'll further understand how this tax benefit is different from tax evasion. So for that, government came up with GAAR, General Anti-Avoidance Rules. because evasion was already being taken care of by penalties like under-reporting of income, misreporting of income. Tax planning was already legal. What was legal and was being practiced widely was GAAR, and therefore government came up with a 7-section arrangement of GAAR, wherein these 2 sections are the most important ones. It basically says that if there is any agreement that income tax department feels with the objective of which is to obtain a particular tax benefit of more than 3 crore rupees, then income tax department can say that this arrangement is impermissible. Okay? Okay? One thing to remember is 3 crores worth of tax benefit, if it is the objective of the transaction, then you are going to go into GAAR. Now comes the real question. How is the government going to identify that this particular transaction is for the tax benefit itself? Say for example, I go in SEZ unit, I want to establish my manufacturing unit, I get a deduction of 3 crore rupees. Does it mean that my decision of making an establishment in SEZ is a GAAR banned transaction, impermissible transaction? No. Therefore, we see section 179. Section 179 lays out 2 tests. First test, as we discussed, the main purpose should be to avoid taxes, and then there are 4 additional tests. If any of these 4 elements are there in a transaction, then it will be identified as a impermissible transaction, arrangement, structure, or whatever. First is, if your arrangement creates any rights or obligations which are not ordinarily created at arm's length prices. For example, I have an asset, I need lease rentals in my balance sheet, I need lease rental expenses in my balance sheet. What I'll do is, I have the same asset, I'll sell it to someone else and get the same asset back to me via lease. So there are rights and obligations which are being created. Then we have misuse and abuse of provisions. The provisions are being used in such a manner that it was never intended to be used. Say for example, there is a company ABC, it has very good presence in its business in South India, say. But government came up with a scheme wherein if you establish a unit in Sikkim or Himachal Pradesh, you will get 5 years of tax holiday. That government does what? That government establishes 3 more companies in Sikkim and Himachal Pradesh. Now the entire turnover in the South Indian company of 150 CR, say. 150 CR of turnover is now routed through 3 companies in Sikkim and Himachal Pradesh, 50 CR, 50 CR, 50 CR. Okay, so government बस इनवॉइस ही चेंज करना है. इनवॉइस सिक्किम से आ जाएगा, इनवॉइस हिमाचल प्रदेश से आ जाएगा. So the provisions are being used, provisions are being abused, misused. Then you have lack of commercial substance. We have separate section for that. Then you have unusual means. Basically, the transaction is such that there are terms and conditions which are unusual, which does not happen in ordinary course of business. Now, the third part, lack of commercial substance. When does government come to know that this is a transaction without the commercial substance? There are some elements which it has prescribed. For example, I'll just brief you out. Round trip financing, accommodating party, offsetting elements, disguised transactions. These are some of the elements that you can take note of and study later. So basically, if this transaction had no consideration about tax, then it would make no sense without tax for this transaction to take place. That's what it basically means. If there was no tax, then you would never enter into this transaction. If that has been proven by the department, then it can be said as it is a transaction lacking commercial substance. Now we'll look into some of the case studies through which we can understand that this transaction lacked commercial substance. For that, we'll understand something known as bonus stripping. It is something. So if you come to know that there is a company which is going, does anyone know what is bonus stripping? Alright. If a company is going to issue bonus shares, once it issues bonus shares, say for example, you purchase 100 shares of 1,000 each, so you spent 1 lakh rupees. Now company issued 1:1 ka bonus shares. Okay. Now this 1,000 rupees now will be reduced to 500 rupees at market price, right? So you purchase something at 1,000 rupees, now the value of that is 520 after that, and you sell those shares. The market value is just reduced because of the bonus shares, right? what will happen is you might have already some capital gains in your account, say for example somewhere in the range of 5 CR. Now you sell those bonus shares because market price is reduced just because of the bonus shares. You will settle that loss because of the bonus shares with the capital gain that you already have. Basically, using the bonus shares can use just to set off the already existing gain. The entering into transaction of purchasing the shares is to obtain a tax benefit. Obtain a tax benefit of setting off your capital gains. Something similar happened in the case of Ayodhya Rami Reddy Valla versus PCIT, Principal Commissioner of Income Tax in Telangana High Court. So a company just basically sold all of its shares to group companies of itself so that it at lesser value. So it incurred a loss. It already had a LTCG of 462 crores. Now 462 crores worth of gain was again set off with that loss, and therefore it was characterized as a transaction under GAAR, impermissible avoidance agreement. Then comes Hinduja Global's case, wherein Hinduja Global sold one of its undertaking or business venture for a capital gain of $1.2 billion. Right? Now, in the ITR, $1.2 billion sits there. After 3 months, what Hinduja Global Solutions did was, it went to another company named Next Digital. It was into digital communication. Can you guess what it had? It had accumulated losses. It wanted to use the accumulated losses of Next Digital so that it can set off the USD $1.2 billion of capital gain. Government highlighted this. It said that the purchase of Next Digital by Hinduja Global was into healthcare and Next Digital was into digital communication. There is no business synergy in this transaction. There is no reason why a healthcare company would purchase any company having its business in digital communication. The only reason why this demerger has taken place is because Hinduja Global wants to use the accumulated losses to set off its already sold capital gains. Bombay High Court has granted a stay on this merger. As we speak, this transaction is being discussed as Bombay High Court. And our favorite Tiger Global that shook the entire industry, that was a matter of buzzword for the entire CA industry. It was something similar to Vodafone again. Flipkart had its business in India. Does it have its business in India? It was held by a company in Singapore. Okay. This Singapore company was again held by a company in Mauritius. Mauritius sold those shares of Flipkart Singapore to somebody in US. So Indian government said what? The shares which you have transferred of Flipkart Singapore, even though they belong to a foreign company, they are deriving substantial value from a capital asset in India, which is Flipkart in India. And therefore, Supreme Government basically said no. 14,500 crores worth of gain, you are supposed to pay taxes on that. And even though you have Mauritius tax residency certificate, it does not mean that you can transfer any asset of foreign company which is deriving substantial value. Now when you further research about this GAAR provisions, you will come to know that most of the investment holdings are being taken place from Mauritius, Netherlands or Singapore or Cayman Islands. Why? Because these are the countries which have no capital gains effectively. Basically, if I have 100 shares, if I sell those 100 shares, be it 100 CR, 50 CR, 1000 CR, they are not going to charge me any capital gain. So what I'll do is, I'll establish my business in India, but that business will be held by Mauritius company. When Mauritius sells this business, there will be no tax in Mauritius company, and I can effectively use the entire amount. So as future generation CAs, our role will not only be to find whether a transaction, whether an arrangement is legal, it will also be to find out whether that transaction makes a sense even if tax was not there. That's what simply GAAR means. Thank you so much.